Let's dive in with this. The big swings in the stock market, they have everyone's attention, but some are warning that the larger concern should be the big sell-off in the bond market. Can you explain that? And should that be something that people should be concerned with?
You got a bond sell-off and you got an equity sell-off at the same time.
Mm-hmm.
And there's a lot of positions that are being moved. In the stock world, the bond world, ETFs and mutual funds. There's a lot of turbulence because of the tariffs. I mean, the market is overpriced. There was a lot of speculation on, different equity positions throughout the last couple of years, which boosted the valuation of them significantly high. And, there has been a market sell-off. So we have to look at, in your situation for, your money. So, you could be in a different phase. There's people that are in retirement now. There's people retiring in 3 years. There's people retiring in 10 years. There's people in their 20s and 30s listening to this show. And what you don't want to do is be emotional about what happens in the market. The market is always going to have growth. We're going to have turbulent times. Ideally, it's understanding, what risk level you're taking, how much risk you should be taking. What is the purpose of the account? Is this something for capital appreciation? Is this something for income distributions? We have to look at what is the purpose of the money, and then from there, where is it investment? What's the proper place of investment? What is the liquidation schedule? Or maybe should you be contributing? I mean, like right now, there's a lot of good buys out there because they have depressed values, which makes things attractive. So it's there's people selling off, but there's also a lot of people buying at the same time. So ideally, it's a matter of understanding what position you should be taking and what's the strategy overall. We have to look at someone's level of net worth to figure out what vehicles that they could be, utilizing. So, whenever someone's net worth is sub $1 million, there's, certain strategies that could be deployed for them. Mm-hmm. And then if someone's worth over 1 million or 2 million or 5 million, then there's a different structure of investments and investment styles that could be utilized. And what we have to figure out is, what are they trying to do? What are they trying to solve? What is their risk tolerance? What is their time horizon? We have to look at all these things to figure out, what's the best option. And, we don't know how long we're going to see a sell-off for. Obviously, the market's turbulent. We just have to look at when's it going to turn around and how to position ourselves at the best way possible to take advantage of, the appreciation and the opportunities to create more income in their portfolio using the right types of equity positions.
Again, trying to figure out what works best for you whenever there are threats out there, financial threats and news. There's also opportunities out there, perhaps not utilizing and taking advantage of these bonds that are being sold off, but maybe finding alternative investment vehicles and finding ways to, again, at the end of the day, make sure that you minimize what the tax implications are going to be, because it's not just about the market volatility, the ups and the downs of the market. If you've got enough time on your side, and everyone's retirement horizon looks different, but there's certainly money in there. Even if you are entering into retirement, you're not going to be touching for 10, 20 years where you can't think like a reminded investor, but what are the tax implications down the line with those? Because, if you write that check to Uncle Sam, when you write that check to Uncle Sam, like I think a lot of us have experienced, it's gone. It's not coming back. So it's not one or the other. It's all encompassing. And that is what the team at Matthew James Tax and Wealth Management helps you with a properly structured investment and also retirement plan. But you have to take that first step and reach out with them. 337-366-8366. Again, 337-366-8366, or going online, set up that complimentary time to speak with them as well at MatthewJames.com. When Bill Bengen created the 4% rule in the 90s, he created it in the 90s, and the going theory was if the market averaged 9% and you take 4% out each year in retirement, you're never going to run out of money. But in his new book called A Richer Retirement, he revised the rule. It's not as catchy, but it's now the 4.7% withdrawal strategy. Here he is on the Decoding Retirement podcast on Yahoo Finance explaining.
The 4% rule or 4.7% rule is designed to be a worst case scenario. If you take out at that low rate and you don't meet those worst case situations, the money's just going to pile up during retirement. And probably later in retirement, you're going to have some regrets wondering whether you should have and could have spent more.
John, do you and the team agree on a percentage pool for your money? And if not, why? And what else do you maybe look at?
Well, the thing is, we got to figure out, it's not technically a percentage. We know where there's like a dangerous percentage, whenever you're taking money out. We have some people coming in thinking they can withdraw 8 and 9, 12% a year and still keep their money for the long haul. And because, they were told, well, my portfolio can average 14, 15% a year by someone else, not us. And then we can draw that and we'll survive. And I'm like, the thing is, and with when you're going into retirement, you're flipping a breaker where you went from accumulation without taking money out of your account. You're adding money to it, and you're focused on grow, and you have a job, paying your bills, paying your mortgage, raising, helping the financial situation of raising your kids, getting them through, high school, college, et cetera, to living off your own money. And so the biggest risk in retirement is the sequence of returns risk. And a lot of people aren't aware of that. There's a lot of people that try to climb Mount Everest, but there's actually significant fatalities on the way down, on the descent. So in retirement, if you're taking too much risk, experiencing a lot of volatility, and pulling out money at the same time, you're going to shorten the time horizon of your portfolio. And that's the key thing. If we look at the last 25 years of the S&P averaged 7.07% as the rate of return. Mm-hmm. So if you're taking out, 4% a year, what will happen? That's what we have to look at. What will happen if you pull that amount of money out each and every year? Yeah, so like the last 25 years, the market averaged 7.07%. And, if you think, if it averaged that, and if I'm pulling out 4, should I have a surplus or a shortfall? And most people would say surplus, because 7.07 is greater than 4. Mm-hmm. But the thing is, sequence of returns risk is the biggest risk, one of the biggest risks in retirement, whenever you, from a distribution standpoint, looking at the valuation of your portfolio after X duration of time. The problem is that whenever you're getting these big losses, and so over the last 25 years, we got hit right out the gate, the first 3. 2000, 2001, 2002, the market was down 10, 13, and negative 23%. In 2008, 38%. I know a lot of people remember that. Yeah. In the last couple of years, we had some turbulence as well. Well, if you had $1 million portfolio and you pulled out 4% a year, even though over that 25-year period, your portfolio averaged 7%, you're left with a little bit more than $200,000 when you started off with $1 million. That's something that we have to pay attention to, because if you're looking at having money for your surviving spouse, money to pass along to your children, and some people look, I don't want my kids to get anything. Look, I understand that, but let's say if you don't blow all the money you have, you don't spend it all, and there's money left over, you want them to at least get as much as they can, and make it tax efficient. So that's the key thing, is we have to look at the amount of money that you need and to supplement your Social Security check and your pension, if you're getting that too. And if the withdrawal amount that you have to take is substantial, and when I say substantial, like north of 5, we need to pay attention to what kind of volatility you're exposed to. So the key thing there is, instead of creating a whole bunch of risk, sequence of returns risk, we have to look at, we got to build a portfolio that has consistent valuation with income. So good quality, dividend paying positions that don't have a whole lot of price